Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Airlines don't usually fail because people stop flying. That's the strange thing about this industry. The planes can be full, the brand can be familiar, the routes can still have demand, and the company can still run out of road.
That's what makes airline failures so confusing from the outside. People see passengers in the terminal and assume the business must be working. But in aviation, activity and profitability are not the same thing.
Today on Aviation Intelligence Weekly, this is a one-time special episode, Why Airlines Fail, using Spirit Airlines as the case study.
Not a weekly recap, not a headline reaction, and not a biography of Spirit.
This is a framework episode.
Because Spirit's collapse is not just about Spirit. It's about the basic economics of airlines and why this industry has spent its entire history producing cycles of growth, stress, restructuring, consolidation, and failure.
This episode's thesis is simple. Airlines fail because of structural economic pressures, not one-off mistakes.
Bad decisions can accelerate the problem. Strategy matters, management matters, timing matters.
But the deeper issue is that airlines operate inside one of the most unforgiving business models in the economy.
High fixed costs, fuel volatility, competitive pricing pressure, cyclical demand, and enormous operational leverage.
That's the framework.
And once you understand that framework, Spirit starts to look less like an exception and more like the latest example of a very old pattern.
So let's start with the core question. Why do airlines fail?
The first reason is high fixed costs. Airlines have massive expenses before a single passenger gets on the airplane. Aircraft leases or debt payments, maintenance programs, airport facilities, crew training, technology systems, gates, ground handling, and labor all have to be in place before the airline can sell the product.
And that's the operator's problem. You cannot run an airline halfway. You either have the aircraft, crews, maintenance, dispatch, customer support, airport operation, and regulatory compliance structure, or you do not have an airline.
Exactly. A software company can slow hiring or delay a project and still keep very high margins. An airline does not have that flexibility. The airplane payment is still due, the crews still need to be paid, and the maintenance program does not stop because fares are weak.
So even if demand drops, the cost base does not drop at the same speed.
And that is the investor problem. Airlines have very little room for error because so much of the cost structure is fixed or semi-fixed. A modest revenue decline can turn into a major financial problem very quickly.
This is why airlines chase load factor so aggressively.
Right. They need to fill seats because each empty seat means the airline is still carrying the cost of the flight without capturing the revenue. But the danger is that filling the seat at the wrong price does not solve the problem.
A full airplane can still lose money.
That sounds impossible to a lot of people, but it is central to airline economics. If the fare is too low, fuel is too high, or the cost structure is too heavy, a full airplane is just a busy airplane. It is not necessarily a profitable airplane.
So pressure one is high fixed costs. The airline has to keep the machine running, and the machine is expensive.
Pressure two is fuel volatility.
Fuel is the classic airline problem because it is both essential and largely outside the airline's control.
Airlines can hedge. They can buy more efficient aircraft. They can adjust schedules. But they cannot decide what global oil prices are going to be. And when fuel moves quickly, the airline does not always have the ability to pass that cost through to passengers.
Operationally, fuel volatility is brutal because it hits every flight. It does not care whether the route is strategically important, whether the fare was discounted, or whether the customer bought extras.
And for investors, fuel creates margin uncertainty. An airline can look stable in one quarter and then face a completely different cost environment in the next. That makes earnings hard to forecast and hard to sustain.
The hardest version of this is a low-fare airline facing a fuel spike.
Because low fares leave less cushion. If the airline raises prices too much, it risks losing the price sensitive customer. If it does not raise prices, the margin gets squeezed.
So, fuel is not just a cost line, it tests the entire business model.
Exactly, it tests pricing power.
Which brings us to the third pressure: competitive pricing.
Airlines sell a perishable product. An empty seat on a flight that departed yesterday is gone forever. You cannot store it, you cannot put it on a shelf, and you cannot sell it next week.
That creates a constant incentive to discount.
And when multiple airlines serve the same market, the discounting pressure can become intense. If one carrier cuts fares to fill seats, other carriers often have to respond, even if the lower fare is not especially attractive.
That is where the industry starts to punish itself.
Yes, from the customer's perspective, this is great. Lower fares, more choices, more access to travel. But from the investor's perspective, the value often gets competed away before it can become durable profit.
The passenger captures the benefit.
That is one of the most important ideas in this episode. Airlines are very good at creating consumer value. They are not always good at retaining shareholder value.
And sometimes the discounting is rational in the moment.
That's the trap. An airline may cut fares because an empty seat produces no revenue. Another airline responds because it does not want to lose share. Then another follows. Each decision makes sense individually, but collectively, the market becomes less profitable.
So, pressure 3 is not just competition, it is competitive pricing in a perishable, high fixed cost business.
Exactly. That combination is dangerous.
Pressure 4 is cyclicality.
Airlines are tied to the economy. When consumers feel strong, they travel. When business is strong, corporate travel improves. When the economy weakens, travel does not always disappear, but the quality of demand can change quickly.
Explain quality of demand.
People may still fly, but they become more price sensitive. They delay trips, they trade down, they wait for promotions. Businesses reduce discretionary travel. Leisure travelers look harder for deals. So the airline may still have passengers, but those passengers may generate lower revenue.
That is especially important for carriers that depend heavily on discretionary leisure travel.
Correct. Leisure demand can be large and powerful, but it is sensitive to household budgets. If the customer base is stretched, the airline has less ability to raise fares without weakening demand.
So again, full planes do not automatically solve the problem.
No, the question is not just how many passengers are on board. It is what they paid, what it costs to carry them, and how much financial cushion the airline has left after the flight operates.
That leads into the fifth pressure: operational leverage.
Operational leverage is the reason small changes can have huge effects. Because airlines have such large fixed costs, a small improvement in revenue can produce a meaningful improvement in profit. But the reverse is also true. A small decline in fares, a small rise in fuel, or a small operational disruption can wipe out profitability very quickly.
So operational leverage is the amplifier.
Exactly. High fixed costs set the baseline. Fuel volatility changes the cost environment. Competition pressures fares. Cyclicality affects demand. Operational leverage turns all of those into a much bigger financial swing.
This is why airlines can go from stable to stressed faster than people expect.
And it is why airline investors are often cautious even when the travel environment looks healthy. A busy airline is not necessarily a resilient airline.
So the framework is clear. Airlines fail when high fixed costs, fuel volatility, competitive pricing, cyclical demand, and operational leverage stack on top of each other.
And this is not new.
We have seen the pattern across aviation history. Pan Am is one famous example, a legendary brand with global recognition, but brand equity could not overcome the economics forever.
Eastern is another example, where labor pressure, route pressure, cost pressure, and competitive pressure all collided.
And more broadly, the industry has seen carriers like TWA, ATA, Aloha, and others struggle, restructure, or disappear under different versions of the same pressure cycle.
The point is not that every failure is identical. The point is that the pattern keeps returning.
Different airlines, different decades, same structural forces.
And that is why looking for one single cause can be misleading.
People want the clean answer: bad management, a failed merger, fuel, labor, competition, debt.
But airline failure usually comes from pressure stacking. One factor weakens the company, another reduces flexibility, another compresses margins, and eventually the airline no longer has enough room to recover.
So now apply that framework to
Spirit Airlines.
Spirit was not just a smaller airline with cheap tickets, it was one of the clearest examples of the ultra low cost carrier model in the United States.
The ULCC model is simple in concept. Strip the product down to the basics, offer a very low base fare, and charge separately for extras like bags, seat assignments, priority boarding, change flexibility, onboard food and drinks, and other optional services.
And operationally, that can work.
It can work very well when the cost structure is genuinely low and the fare difference is obvious to the customer. Spirit helped stimulate demand by offering prices that made flying accessible to people who might otherwise drive, delay the trip, or not travel at all.
So the model was not irrational.
No, Spirit changed the market. It forced larger airlines to respond. It made pricing more transparent in some ways because customers could choose the stripped down fare or pay for the extras they wanted.
But the model has a vulnerability.
It depends on maintaining a real cost advantage and a real price gap. If Spirit is meaningfully cheaper than everyone else, customers may accept the trade-off. But if the price gap narrows, the customer starts comparing the whole experience.
And that is where legacy carriers became more dangerous.
Exactly. The large network airlines did not need to become Spirit. They just needed to defend the low end of the market. Basic economy allowed them to offer a cheaper fare while still keeping the broader advantages of the legacy model.
Bigger networks, loyalty programs, credit card economics, premium cabins, corporate relationships, international partnerships.
All of that matters. A legacy carrier can compete for the price-sensitive traveler while still monetizing other customer segments. Spirit had fewer revenue buffers.
That is the core competitive issue.
Spirit's revenue model leaned heavily on price-sensitive customers and ancillary fees. That can be powerful when the total price is clearly attractive, but it becomes harder when competitors narrow the base fare gap or when the final trip cost after fees starts to feel less distinctive.
So let's take Spirit through the same framework.
First, high fixed costs. Spirit was a low-cost airline, but it was still an airline. It still had aircraft obligations, crews, maintenance requirements, stations, technology, airport operations, and regulatory compliance. Low cost does not mean low fixed cost in the way people sometimes imagine.
That distinction matters. A ULCC can simplify the product, but it cannot simplify away the fundamental requirements of operating an airline.
Right. The aircraft still have to fly, the crews still need to be trained and paid, maintenance still has to happen, the operation still has to meet the same safety expectations as everyone else.
So when revenue pressure hits, the airline cannot shrink the cost structure instantly.
Exactly. And that creates stress.
Second, fuel volatility.
Fuel is especially difficult for a low fare carrier because the model depends on keeping prices attractive. If fuel rises, Spirit has to either absorb the cost or raise fares and fees. But if it raises the total trip cost too much, it risks weakening the very value proposition that attracts customers.
So the airline has less pricing power?
That's the key. A premium heavy airline can sometimes recover more cost through higher fares, corporate demand, loyalty customers, or premium cabin revenue. A ULCC has fewer of those levers.
Third, competitive pricing.
Spirit's identity was built around being cheaper, but over time, the rest of the industry became better at competing against that. Legacy basic economy attacked from above, while other discount carriers competed from the side. That meant Spirit could face pressure from both network carriers and low-cost competitors at the same time.
And if your main differentiator is price, competition on price is especially dangerous.
Yes, price is powerful, but it is also fragile. If another airline can get close to your price while offering more network utility or a better perceived experience, the customer has a reason to switch.
Fourth, cyclicality.
Spirit's customer base was highly exposed to discretionary leisure travel. That does not mean the demand was weak, it means the demand was sensitive. When household budgets tighten, those customers become more selective, wait for deals, or reduce travel.
Which creates a mismatch.
Exactly. The airline may need higher fares to cover rising costs, but the customer may need lower fares to travel at all.
And fifth, operational leverage.
This is where the stress compounds. A fuel increase, weaker yields, competitive discounting, aircraft availability problems, or softer demand can each be manageable on its own. But when several hit at once, the effect is much larger than the individual pieces.
That is the airline failure pattern.
Yes, Spirit did not fail randomly. It followed the same structural pressures that have broken airlines for decades.
Now let's be careful.
Good point.
We are not saying every ULCC has to fail, and we are not saying Spirit never had a viable model.
Spirit's model was viable under the right conditions. Low costs, strong price stimulation, high utilization, clear fare advantage, and a customer base willing to accept unbundling.
The question is durability.
Can that model remain profitable when the cost gap narrows, fuel rises, competitors adapt, and the customer becomes more sensitive?
For Spirit, the answer became no.
Structurally, several things went wrong.
The first was fuel pressure against low fares.
Low fares leave less cushion. If fuel costs rise, the airline has to recover that cost somehow. But a ULCC cannot always raise fares without undermining its own appeal.
The second was competition compressing margins.
Spirit needed to be clearly cheaper, but when legacy carriers offered basic economy and other low-cost carriers fought for similar customers, Spirit had less room to command even modestly higher total revenue.
The third was limited differentiation.
Spirit had a clear brand, but the brand was heavily tied to price. Cheap is valuable, but cheap is not the same as durable differentiation. If the customer's main reason to choose you is price, the customer can leave when the price advantage disappears.
And the fourth was economic sensitivity.
Spirit's customer base was more exposed to budget pressure. That makes the business more vulnerable when consumers become cautious. The airline may need pricing strength at precisely the moment its customers demand discounts.
So Spirit's problem was not simply that passengers disliked fees.
No, fees were part of the model, but not the whole story.
It was not simply one merger outcome.
No, strategic events matter, but they sit on top of the economics.
And it was not simply one bad quarter.
Airline failures usually do not work that way. They are cumulative. The business absorbs pressure until it cannot.
This is why resilience matters so much in aviation.
Airlines face shocks constantly. Fuel shocks, labor shocks, maintenance shocks, aircraft delivery delays, demand shocks, weather disruptions, regulatory issues, and capital market pressure. A strong airline is not one that avoids shocks. It is one that has enough financial and operational flexibility to survive them.
Spirit had fewer buffers than the larger network carriers.
That is the investor lens. The strongest airlines usually have multiple profit pools. They have loyalty programs, premium revenue, international partnerships, corporate accounts, co-branded credit card economics, cargo opportunities, and network advantages.
Spirit had a narrower model.
Yes, narrower can be efficient, but it can also be brittle. When the narrow model is under pressure, there are fewer places to hide.
So let's talk directly about airline stocks.
Airline stocks are structurally difficult because airlines are capital intensive cyclical businesses operating in brutally competitive markets. They need a lot of money to operate, demand moves with the economy, and many passengers choose primarily on price.
Even good airlines struggle with that.
They do. A good airline can still face fuel spikes, labor inflation, aircraft constraints, recessions, and fare pressure. The best operators build buffers, but they cannot fully escape the industry structure.
That is why investors often treat airlines differently from normal consumer businesses.
Exactly. A strong brand in another industry might create pricing power and durable margins. In airlines, a strong brand helps, but the customer still sees a schedule and a fare. If another airline offers a similar flight at a lower price, the brand advantage gets tested.
And because seats are perishable, the pricing pressure never really goes away.
Right. The industry has moments of discipline, but the underlying incentive to fill seats is always there.
So when an airline is profitable, investors have to ask whether that profitability is durable or just a favorable point in the cycle.
That is the right question. Is the airline profitable because it has structural advantages, or because fuel is manageable, demand is strong, competitors are disciplined, and the cycle is favorable?
And if the answer is mostly the cycle, the risk is higher.
Exactly.
Here is the key insight.
Airlines are designed to create value for customers, not shareholders.
That sounds harsh, but it explains the industry.
Passengers want low fares, more routes, reliable schedules, and flexibility. Employees need rising wages, benefits, and stability. Airports want service. Lessors, lenders, suppliers, and maintenance providers all need to be paid. The shareholder is often last in line.
And in a downturn, there may not be much left.
That is why airline failures can happen even when the airline is useful. Spirit was useful to customers. It lowered fares. It forced competition. It expanded access to travel. But usefulness is not the same as financial durability.
That is the central lesson.
A business can create enormous consumer value and still be a difficult investment.
So when people ask, how can an airline fail when people are still flying? The answer is that demand alone is not enough.
You need profitable demand, you need pricing power, you need cost control, you need balance sheet flexibility, and you need resilience against shocks you do not control.
Spirit's story shows what happens when those pieces weaken at the same time.
And it also shows why consolidation and failure cycles keep returning.
Because when the industry becomes too fragmented or too competitive, margins get competed away.
Weaker carriers get tested first.
Some restructure,
Some merge.
some disappear.
And then, after capacity leaves the market, the surviving airlines often become stronger.
That is painful for employees and communities.
Very painful. Airline failures are not abstract. Jobs are affected, routes are affected, customers are disrupted, and entire local markets can lose service.
But from a market structure perspective, this is how aviation has often reset itself.
Weak capacity exits. Stronger carriers absorb demand. Pricing may improve. The cycle stabilizes until the next growth phase begins.
And then new competition comes in,
Lower fares return.
capacity grows,
Costs rise.
margins compress.
And the cycle starts again.
So, Spirit is the case study, but not the whole story.
The story is airline economics.
A business where demand can be real, the planes can be full, the brand can be known, and the company can still fail.
Because aviation is unforgiving.
High fixed costs,
Fuel volatility.
competitive pricing,
Cyclical demand.
operational leverage.
That is the mental model.
Once you see it, airline failures stop looking surprising.
They start looking structural.
That is it for this special episode of Aviation Intelligence Weekly.
We'll be back with our regular coverage of aviation markets, public airlines, manufacturers, and the capital forces shaping the industry.
Until then, remember, full airplanes are only part of the story.
The real question is whether the economics work after the airplane is full.
Thanks for listening. Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Want the inside track on aviation's biggest players? Aviation Intelligence Weekly brings you expert analysis of airline earnings, breaking industry news, and deep dive company histories. From American Airlines to Boeing, we cover the business of flight every week. Subscribe now on Apple Podcasts, Spotify, or wherever you listen.